Welcome to our channel. Today, we're exploring the housing market crash of 2007 to 2008, a critical event that triggered the global financial crisis. We'll examine its causes, the unfolding events, and the far-reaching ripple effects on the global economy. The early 2000s saw a booming housing market in the United States. Home prices were soaring, and more Americans than ever were able to purchase homes. But beneath this prosperity lay a series of risky financial practices that would eventually lead to disaster. Several key factors contributed to the housing market crash. First, there was the widespread issuance of subprime mortgages. Lenders offered loans to borrowers with poor credit histories, often with adjustable interest rates that would later skyrocket. Secondly, these mortgages were bundled into complex financial instruments called mortgage-backed securities and collateralized debt obligations. These were sold to investors worldwide, spreading the risk throughout the global financial system. Additionally, there was a lack of oversight and regulation. Rating agencies gave high ratings to risky mortgage-backed securities and collateralized debt obligations, misleading investors about their safety. Lastly, the Federal Reserve's low interest rates in the early 2000s fueled the housing bubble, making borrowing cheaper and encouraging speculation. The crash began in 2007 when home prices started to fall, leading to a rise in mortgage delinquencies and foreclosures. As more homeowners defaulted on their loans, the value of MBS and CDOs plummeted, causing massive losses for financial institutions. Major banks and financial firms, heavily invested in these toxic assets, faced insolvency. Bear Stearns collapsed in March 2008, followed by the bankruptcy of Lehman Brothers in September 2008, which sent shockwaves through the global financial system. The housing market crash quickly escalated into a global financial crisis. Stock markets around the world plunged, wiping out trillions of dollars in wealth. Banks and financial institutions faced severe liquidity shortages, leading to a credit crunch that stifled economic activity. Unemployment soared as businesses cut jobs and consumers curtailed spending. The U.S. unemployment rate peaked at 10% in October 2009, while countries worldwide experienced recessions. Governments and central banks intervened with unprecedented measures. In the U.S., the Federal Reserve slashed interest rates and implemented quantitative easing. The government passed the Troubled Asset Relief Program, or TARP, to bail out banks and stabilize the financial system. The housing market and broader economy gradually recovered over the next decade. Home prices began to stabilize, and financial markets regained their footing. However, the crisis left a lasting impact on millions of people and reshaped the financial landscape. In response to the crisis, significant regulatory reforms were enacted. The Dodd-Frank Act introduced stricter regulations on financial institutions to prevent a repeat of the risky behaviors that led to the crash. The housing market crash of 2007 to 2008 serves as a stark reminder of the dangers of unchecked financial speculation and the importance of robust regulation. By understanding these events, we can work towards a more stable and resilient financial system. Thank you for watching. If you found this video informative, please like, comment, and subscribe for more insights into financial history and market analysis.